Hey everybody, and welcome back to the Sumrok Studios. I am your host, Carl Dean, and today we have another one of our top service providers with us, Mr. James Ng from Old Capital. James, welcome.
How's it going, Carl?
Not too bad, man. So I'm sure many of you guys have heard of James if you are a fan of the Old Capital Real Estate Investing podcast. If not, I highly recommend it. It's a very, very good informational podcast. It's not like one of those podcasts you listen to that's pitching, all kinds of different services or whatever. It's very, very educational. They've got some really high-level people that they have had on the show. And you guys have been on the air for how long now?
4 years now.
4 years,
Yeah,
wow.
So we put out 2 a week, and we probably get about 40,000 downloads a month on it. So
Two podcasts a week?
2 podcasts a week. So we usually do like a Q&A portion, and then we also do sort of long-form interviews.
Okay, yeah. I mean, that's something that when I was first getting into the business as an asset manager working with Becker, that was like the Bible. I mean, that was like everything I needed to know about real estate investing was in that podcast, whether it be financing or operating or setting up your team. And just the amount of information you guys have on that is just mind blowing. So hats off to you guys for that show. It's great.
Yeah.
So let's dive into this a little bit, James. So you guys have been with the Sumrok group for 3 or 4 years now?
No, I mean, I think it goes back. I mean, Paul really started with Brad when Brad sort of moved over and started this whole program.
Really?
And so he's been doing loans for the group. And then I actually started in 2015 with Old Capital. Okay. And so since 2015, I've worked with a lot of students. I mean, I brought you sort of the list. I mean, last year I think we did over 150 million in loans with Brad's group.
Really?
So, I mean, it definitely has snowballed into bigger deals, more deals, the past couple of years.
Yeah.
So a lot of deals. Yeah.
What's your guys' total deal volume on an annual basis?
Yeah. So 2018 we did $1 billion in loans.
Okay.
Probably 10 to 15% was really out of Brad's group. So
Wow,
we did
okay.
a lot of loans for Brad's group. And I mean, I think one important thing to note is really, when you're starting to work with a mortgage broker, a lot of them, they sort of want you to have everything figured out up front. But we're a little different. We sort of help people through the process. So, I mean, last year out of, let's say, 15 loans that I did for Brad's group, I mean, probably half of those were for first-time guys. So
really?
Guys who just got started and sort of holding their hand through the process, figuring out what type of loan is the best product for that particular property and then for their group.
Wow. So you guys kind of specialize in the beginner investors.
Yeah,
kind
for sure.
Helping grow them up.
Yeah, and I mean, I think it also depends, when we help a first-time guy, that person's going to need different stuff than somebody who's doing their third or fourth deal.
Yeah.
And so depending on your level of sophistication, we're going to bring different things to you.
Okay, that's excellent. Yeah, so you guys have, I know you guys have done all kinds of deals, for anywhere from, because you're a loan broker, right,
Yep.
obviously, and anything from bridge debt to agency debt, which is Fannie and Freddie. Talk to us about kind of the differences between those loans, and then if there's one in particular that you think is the better program, talk to us about kind of how that all works.
Yeah, man, I like to explain it with sort of 3 questions. The first question is sort of the occupancy of the property. And so is it stabilized, 90% occupied for the last 90 days? The second question is really around your experience. So have you done a multifamily deal? Have you owned a deal before? And then third is really what's your net worth and liquidity? Okay. And so those 3 questions are really going to give me a idea on what loan product to go into. So if you're doing a first-time deal on a stabilized deal, you're probably going to be sort of in that bank recourse loan column. But then as you move in and get a little bit more experience, then you're going to go over to agency, so Fannie and Freddie.
Okay.
And then the last sort of product that we have is really on the non-recourse bridge side. And that's going to be for somebody who's done 3 or 4 deals. They're more experienced, but the property maybe isn't there in terms of occupancy. So it might be a 70, 80% occupied property.
So that's more of a short term, trying to stabilize it, be able to put the agency debt on it later?
Yes. So you're going to, go in, put a good amount of rehab, typically $5,000 to $10,000 a door into the property, and then either sell it in 18 to 24 months or refinance it into more permanent debt.
Okay. So talk to me about, like, I hear some people that want to go direct versus using a loan broker.
Sure.
I'm obviously a fan of letting experts do what they do best and
Absolutely.
staying in my lane, right? Talk to us about kind of how that works, and you explained it to me beforehand here with the ice cream remedy. Share that with the viewers.
Yes, I mean, I think a lot of people, they go, well, why don't I just go to the bank? And the ice cream analogy that I was using was, you walk into an ice cream shop and all they got is chocolate. So whether you want chocolate or not, they're giving you chocolate ice cream. That's all you're getting. Whereas a mortgage broker like Old Capital, we're going to be sort of like your Baskin Robbins, right? We've got all the different flavors. If you don't like chocolate, we got vanilla. You don't like vanilla, we got strawberry. So there's all these different loan products that we have access to, and we are closing just so many loans in those different types of loan products that when we call those bankers, they're responding to us quickly, right? So we might close maybe 15, 20 loans a month across different platforms, and you might be doing one loan this year. Yeah. And so when you walk in the door, the banker looks at you and just sort of says, "All right, this guy may or may not use me." Yeah. And they're going to do one deal this year. Whereas we're going to come in and we're going to say, "Look, we've got the deal teed up. We've already vetted the sponsorship group. We've already seen the property. We've toured the property. And this fits your box." Yeah. And so it's very easy for that guy to sort of take the package that we hand them and just run the deal. And they can do a lot more transactions that way. Yeah. Versus trying to, help someone come in on one deal. Yeah. And
yeah, it makes sense. Makes sense. Okay, so yeah, obviously it's like working with the experts, right? Like, I'm not going to go and attempt to try to spend $5,000 on Facebook ads to market my company when I can pay somebody that same amount of money and let them stick with what they know best and get me a better result.
Yeah, I mean, in the same way that you don't want like a management company, right? Like you could manage the property yourself. Or you could, go out and shop insurance yourself. Yeah. But a lot of these things, unless you are in sort of the weeds of the deal on a day-to-day basis, you're going to miss something. Yeah. And
it's not going to be. You're not going to be timely. It's going to be way less efficient.
It's not going to be timely. And I mean, on a lot of transactions today, I mean, you're going hard with earnest money, $100,000, $200,000 day one, and then you're having to close in 45 to 60 days.
Yeah, very good point.
And so if you're going to the ice cream shop and you're looking for vanilla and they got chocolate, and then all of a sudden you're in day 25. Yeah. I mean, your sort of reputation is at risk as a general partner, and you don't want to be put in that situation where you just can't close the deal.
No, that's you definitely don't want to try to tackle financing your deal by yourself. I strongly recommend using Old Capital or any loan broker at that point. I mean, it's just, you don't want to do that unless you're very experienced. Even at SPI, when I was there, we used you guys pretty much for every deal. So, so talk about, let's see, when do we receive approval for a rate lock? So rate locking, that's a good point. So with the market doing what it's doing at this point in time, like we're in, just beginning the second quarter of 2019, we had an inverted yield curve there for a short time. Now we're kind of flattened out. Talk to me about rate locking and what you see right now in the market as far as interest rates and the, I guess, the advantage over maybe 6 months ago or the end of last year. Talk about that a little bit.
Yeah, I mean, in terms of rate locking, really, like on a recourse bank loan, that's really based on deposits. So the bank's taking in deposits and they're going to give you a rate. So let's just say 6%, and that's going to hold no matter when you close the deal. But on a Fannie or Freddie, it's very dependent on 10-year Treasury. So as you see 10-year Treasury go up and down, let's say 200 basis points to that number. That's essentially going to be your rate, depending on the amount of interest only, the amount of the loan term. That's going to determine your rate. And so on Fannie and Freddie, they have what's called sort of a streamlined rate lock. And so you might be closing in 60 days, but you can typically, once you get the third parties back and submit for just sort of a preliminary approval, you can usually lock that rate within 30 days. And so if you get all your due diligence in, the reports come back clean, you can actually go out and lock that rate early. And then you know exactly what your interest rate's going to be, exactly what your loan amount's going to be, and then you know what you need to raise in equity.
Yeah,
right.
It kind of
Because
firms up your numbers for you.
It definitely firms up the numbers.
Yeah.
And so people try to, it's a shortened due diligence list, but once you get those items in, then you can lock the rate.
Yeah. So, is there a good time or a bad time during the month? I know when I was with SBI, again, I keep referencing this because that's my asset management experience, and we worked with you guys a lot.
Yeah.
Is there, we were always trying to time the rate lock, right?
Sure.
It's like an art, what Sean would call it, an art to rate lock, and hit the right day. Because once you lock, you're locked.
Yep.
Right. So I can't, and again, just to make that, in case you guys didn't follow what he was saying with the 10-year treasury, the 10-year treasury obviously reports every single day. It changes up and down, and industry term would be 2 points above that is prime, or 200 basis
200
points.
basis points over the 10-year treasury. So let's say, just use easy numbers, let's say it's 2.5 on the 10-year
Yep.
treasury. 200 basis points over would be 4.5
Yep.
today. So there's a lot of variables in that, but that's just sort of a rough gauge on sort of where rates are today.
Yeah. And so, if I'm sitting here watching the 10-year treasury and I decide to rate lock, and I get a 4.6, and then the 10-year treasury drops down, 10 bips.
Right.
I'm stuck, right? So
Yep.
is there a strategy behind that, like a good time during the month or maybe during the year? Like, are we waiting for jobs reports or things like that?
So a lot of times what we'll tell borrowers is if that interest rate is hitting your loan proceeds, right? So if you said, all right, you modeled the deal at 75% loan to cost, and at that interest rate, you're getting 78% loan to cost. So you're hitting your pro forma, everybody's baked in, then you just need to lock the rate.
Yeah, don't be greedy.
Yeah, don't be greedy on this deal. But if we see a huge spike up in rates where we think that's sort of unsustainable, then we might tell you to maybe wait a couple days. And we've seen where, at the end of, let's say it's Thanksgiving break, everybody's leaving on a Wednesday. Maybe it's not the best time to go out to the market, because essentially what happens is that bank, that lender, that Fannie Mae lender is going out to the market and saying they're doing a bid and auctioning off your loan. And so if there's 2 bidders, you're not going to get the best interest rate. But if there's 10, then you're going to get a better rate. And so that creates your spread, in essence, right? So your 10-year treasury plus that spread is going to give you your final interest rate. And that's what, the beginning of the year is definitely better than the end of the year. So more people are trying to get more money out at the beginning of the year, like right now, than they are in November and December.
Gotcha. That makes perfect sense. So you mentioned earlier that there's been circumstances in which either somebody had a loan that fell through for them and then they came to you for a secondary option, or maybe you were trying to push them through one and it didn't work out. And so talk about that, because I haven't experienced that much, but like something, number one, what would be some of those things that kind of make it fall apart or fall through? Whether it be occupancy or whatever. And then kind of walk me through what your plan B is there.
Yeah, I mean, so it's going to depend on the property, but sometimes people will try to take deals into Fannie Mae or Freddie Mac, and it just doesn't work, right? So whether it's the occupancy or there's a lot of deferred maintenance on the property. Gotcha. So we had an issue where essentially a student of Brad's, they were trying to buy a deal down in Houston, and the listing broker was sort of pushing pretty hard on using Freddie Mac. And I looked at the deal and I just said, that's probably not going to work for that property based on its current condition and its occupancy. But the listing broker was pretty adamant, just sort of jammed it down that system. And then Freddie Mac came back and just denied the deal.
Okay.
And so the borrower sort of had like only 20 days to really close, or they had already extended a couple times.
Wow.
And so they were sort of up against the wall. This was their first deal. Oh. And so they had a lot of pressure to get this thing closed. And so they called me. We brought in a bank. They had to go with a recourse bank loan on the deal. And they actually got it approved like 5 days later. We already had all the reports.
Yeah.
And so we had all the reports. We brought in, showed sort of the sponsorship team, presented the deal, and then they were able to close on time. And that was their first deal. Wow. And so that was in 2017. And then in 2018, they were able to buy 2 deals with Fannie Mae debt up here in Dallas.
And they've never left your side. I brought
Yeah. So it's one of those, like, I mean, our job is really to make sure you don't get that no on that initial read, because you've got a lot of money at risk. We have our reputation at risk. So we're going to do everything in our power to size up the deal, structure your sponsorship team so that we know it fits in that lane for that bank.
Yeah, and in that specific situation,
Right.
you were trying to tell the buyer, hey,
Yeah.
this is probably not going to work based on the property condition.
Yeah.
But always the broker's trying to sell it best case scenario, right?
Yeah,
Like,
I mean, and I mean, we see this a lot right now where the listing broker is saying, look, you can get, let's say, $8 million loan, and they're trying to sell it for $10 million. And so it's great leverage. It's great leverage. And then we underwrite the deal, and we're maybe coming in at $7 million. And we're like, look, you know, if the appraisal comes in or taxes come in higher or the collections aren't there, you're going to get jammed.
yeah.
And, you know, some people are willing to take that risk. They're like, all right, that's fine. But you're going to overpay, but like essentially you should be paying $9 million instead of $10 million for the deal.
Yeah.
And I mean, we like to look at deals, underwrite them conservatively, but then we know what we've gotten approved. That's what the good thing about using a loan broker is. They're constantly in front of Fannie Mae and Freddie Mac.
Yeah.
They're constantly in front of appraisals. So like when you send us a deal, we're not only just underwriting that deal, we're typically looking at appraisals in the area, tax comps in that area to size that deal to make sure that it sort of fits when it goes through the whole loan process. And that helps you get a comfort level with the underwriting compared to just sort of like slapping a one-pager together, sending it to you and saying, all right, here's an $8 million loan quote, and, you know, hopefully it works out. Yeah, it might happen, but it might not.
We'll do our best, right?
Yeah, we'll do our best.
Yeah.
But I think that's important is, you know, my background at GE was underwriting deals. So I was a loan underwriter there. And essentially I would get the package from the sales guy and I would go through the numbers in detail. And a lot of these deals I spent, you know, 15 to 30 days with one deal. So I would know every detail of the deal and have to pitch that to the investment committee. So that was my sort of, you know, learning on the fly because you weren't going to get anything by sort of the chief risk guy. Like there's no, so I think that experience helps me you know, when you get the deal signed up, that's one thing, but then you have the next 60 days to close it.
Yeah.
And almost every deal is going to have something come up.
Yep.
Right? So whether it's a third-party report or your equity raise or your loan proceeds, something's going to come up. And how you address that is huge to you as investors, but then also somebody who does this all the time, they just see a lot more.
Yeah, you're a lot more proactive as far as like seeing what's on the horizon.
Yeah.
Versus one of these guys who doesn't have the experience of doing what you did at GE.
Yeah.
Who's always best case scenario, and then it's a surprise. We didn't get it across the goal line, and you lost your EMD.
Yeah, and a lot of times it's like just having different solutions for a lot of these things, and you know, a lot of people will come to us and then we'll quote the deal, and if they end up using us, you know, we'll make sure it sort of fits in that lane and make sure it closes on time and gives, you know, the listing brokers actually a level of comfort as well that this deal is going to get closed, right? So you as a general partner are responsible for the equity, but we're bringing, you know, 75-80% of the money at close. Yeah. And so, I mean, the quote I like to use is think of us as your largest partner. Yeah. Because if we don't show up at the table, the deal's not getting done. Yeah.
That's a good point. Yeah. Something I had as a question, really for my own personal, you know, deals and investments. I was very curious. There's the green program, right? Yep. So last year and the year before that, everybody's taking advantage of this green program. Yes. Saving like what is it, 25 to 30? Yeah. Okay. Basis points on your loan. Yep. And you were able to hit the mark because you had to have 15% water.
So last year was 25%. Okay, so you either chose water or electric, 25%.
Or a blend.
No, it was one or the other last year. Okay. So in 2019,
which just to clarify, that means, so like let's say we do a water conservation, you have to, execute a game plan, which you can get funding from the lender for.
No, you're putting the money up.
Okay.
Yeah,
You're
putting the money up. So let's give an example. Let's say you're buying 100 units,
Okay.
and you come in and you see the water bill is extremely high. They haven't done aerators, they haven't done shower heads, they haven't done toilets. And in order to qualify for the green program, they'll do what's called a green report, essentially go out there and test the water and look at the toilets, all that. And then if you can achieve savings, so let's say 100,000 is the water bill now, and you can take it to 75,000 with these savings, that 25% decrease is essentially going to allow you to qualify for a lower interest rate. That lower interest rate is going to give you better loan proceeds. And so Fannie Mae is incentivizing you to spend that $50,000 on aerators, shower heads, and toilets, but it's coming out of your pocket.
Okay. But you can't roll it into a loan, so it has to be additional capex raised on the side, or
it's going to be an escrow, so it's similar to like an immediate repair.
Okay, gotcha.
So they're going to escrow it, and then but it's coming out of your pocket. Yeah.
So and now it's a little different because now you have to have 15% water and 15%
15% water, 15% electric, and what I've seen is. So the quote I heard was that 90% of the deals that they did in 17 and 18 should qualify under this program. But people have been a little bit more hesitant to do it because the electric piece can be things like windows, HVAC, lighting, and thermostats. Yeah, so the first two, windows and HVAC, really expensive. Individual water heaters, expensive. But then the lighting and the thermostats, we've seen some properties been able to qualify with those.
Okay.
And so at the beginning of the year, in the first quarter, they saw a lot of people just saying thanks, but no thanks on the green. But now, recently, we're sitting here in April. They've said, all right, you guys just run the green report, and whether or not you do it or not, we'll pay for the report. So Fannie Mae said, all right, we'll pay for the report. But then, but now, so we're getting a lot more reports back now. But now the question is, okay, I'm spending $50,000 on water, but then do I also spend $50,000 on electric to get, let's say, 10 to 15 basis points on the green?
Yeah.
And so it's going to depend on the property, but then also, do you want to spend the money?
Exactly, right. A little bit harder to hit the mark now. I noticed a lot of people are not really going for that as much as they were last year and the year before.
Right, that's correct.
Yeah. All right, so let's talk about what you guys charge, how you get paid.
Sure.
Right, because you're obviously a loan broker. Talk about what the fee is, what it looks like, whether it's a point, percentage, flat fee, and then where does that come out of, and when does that have to get paid?
Yeah, so we don't get paid until your deal closes.
Okay.
And so if we size 20 deals for you, you never use us, we don't ask you for a dime.
Oh, well, okay.
But if...
Sorry to waste your time.
Yeah, but if, we size the deal, we get paid at closing. So the loan's approved, your money is there, the lender's money's there, your equity's there, the deal is closing, then we will charge 1% of the loan amount.
Okay.
And we'll do some smaller loans, but typically our minimum's about $10,000 on any deal, and so that's how we get paid. I mean, it's some people will ask us to negotiate our fee, but it's sort of on a case by case basis. Yeah. Usually the standard is just 1%.
$40 million deal.
If the loan size increases significantly, but typically 1% is the fee.
Yeah. I mean, if you're closing a $70 million deal and you got all the experience in the world, and it's going to be a lot easier process. Maybe there's some wiggle room, but otherwise, pretty much not. So flat fee of 1% gets taken out of the closing. At closing, yeah. So if for any reason a deal fell through for any number of reasons, and you guys have gotten pretty much to the finish line, and it doesn't close
all the way to the finish line, we've gotten to where
nobody eats.
The lender, we've gotten to where the lender has the money at the title company. And we didn't close, and we didn't get paid. So there's always not until it closes. Don't don't post anything on
Yeah,
Facebook.
yeah. Don't post anything.
No
No,
post.
congrats. Don't
Yeah,
take
yeah.
pictures in
Yeah,
front of the
yeah,
property.
yeah.
Just wait. Make sure you get the closing.
So I mean, it's almost it's steps, right? So you do the loan app, you lock the rate, and then you close. So it's all incremental. You want to take it step by step, and I think I put together actually a webinar also like during those 60 days of sort of what you need to be doing. So if you're under contract on a deal and you're not doing anything, there's probably something you should be doing.
Okay, yeah, that's a good point. That's a good point.
Whether it's the loan, paperwork, or talking with vendors, there's something. So a lot of times, buyers will call me, at the very beginning, and then say, all right, what are like the 5 things? Because usually the loan checklist is 50 things.
Yeah.
They're like, all right, what are like the 5 things that I need to be doing right now? And I sort of give them that list and start there. And then once they're done, then I'll give them the next 5. And so taking it step by step, because it can be a little overwhelming at the beginning, especially with the number of parties involved. So you got the seller, you got the listing broker, you got the third party guys, you got your equity investors coming in. And so on a lot of deals, I'm helping people just sort of quarterback that whole transaction to make sure it gets there.
And you said you have a white paper on that?
Yeah.
Okay, so I'll make sure we include the link to the white paper below the video here. And you've also given me some other content here to kind of go over with you. I really appreciate that. Makes my job a lot easier. And will I be able to include these below the video here for the students or whoever may be watching the video? Okay, excellent. Because these are very, very helpful pieces of paper here as far as comparing the different loans, minimum, maximum amounts, flexibility, max LTV. I mean, there's a lot of good stuff here. So I would like to definitely include that if you don't mind.
Definitely.
Another thing I want to talk about briefly is just, your GP board. So I had a student earlier ask me, what's the minimum that I need to invest if I bring a deal, because he's a broker, all right, but he's also a student. And he said, what if I bring a deal and I'm bringing smoking hot deals? But like, do I have to bring in a minimum amount, and what am I able to charge? So talk about like the GP board, and let's just, you can use any easy example to help people understand. But how does that look,
numbers.
and what are the minimums for those people in most cases?
Yeah, I mean, let's take sort of a typical $5 million deal, $4 million loan, $1 million in equity. And let's say the general partnership is getting 20% of the deal, just sort of standard. So they're getting 20% of that $1 million. And now it's, how do you split up the 20%, right? And the first consideration is you got to have a deal. And so whoever brings in the deal is usually getting half. The second thing is you got to have multifamily experience. So if you're going to qualify Fannie or Freddie, you're going to need multifamily experience. So that person's probably going to get a good chunk. And then the 2 other pieces are raising equity and then net worth and liquidity. And so to qualify for that loan, so it's $5 million purchase, $4 million in debt. So you need $4 million in net worth and then $400,000 in post-close liquidity. So after the down payment, the KPs still have to have $400,000 in cash or marketable securities. And so once they have that, then you have the possibility of qualifying for that loan, and then you can actually apply for the loan, and then from there, the next question I usually get is, well, how much equity do I have to put into this deal? And so what we're looking for, if it's $1 million, we're looking for $100,000 in equity, so 10% of the equity in cash coming from the KP group or general partnership group. But then as you get into larger and larger deals, I've seen it where maybe the KP group does 5%. But on these smaller deals, I mean, if you have 2 or 3 people and you only have to put in $100,000, that's actually pretty doable for most people. And then I would say the minimum, if you're asking LP investors to invest in your deal with 50, like as a key principal signing on the loan, like you need to put in that minimum.
Yeah. So the bare minimum is at least what you're asking your limited partners.
That's right.
And the lender's going to want for sure 10%.
10%, yeah, 10% of the GP, especially on deals sort of $5 million to, let's say, $15 million. If you go buy a $30 million deal and 10% is $1 million, maybe that doesn't come just from you. But on these deals, sort of the 5 to 15, I think 10% is a good number to be at.
Okay, good advice here. What are some things that really on the GP board that you can say might be a consistent issue? Like something you see a lot that's on the GP board that just kind of, nope, you're going to have to go back to the drawing table or find another person, or like what's a common issue there?
I think one of the hardest things probably is before someone has a deal, right? So they're like, all right, I'm only going to work with this guy. And we're going to partner together and we're going to buy deals. And then you talk to them like 2 years later and they're like, oh, how come you haven't bought a deal? Well, the one guy I was going to partner with, he didn't like any of my deals, right? So I think at the beginning, nobody is sort of married to somebody else at the beginning.
It makes good sense.
And so I think when you first come into the program, you should sort of date a lot of people, get to know people that have multifamily experience, that have net worth and liquidity. So start trying to fill those boxes in your group so that when a deal comes up, you have a wide variety of people to
That's
go
a good
for.
point.
Yeah.
I never really thought about that. Like you're saying, so guys come in and they're like, well, me and Joe are going to do deals here because we like each other and, we joined the program together and yada, yada. Yeah. But you guys can't get on the same page and you like this market and this deal and he doesn't really like that. So just be more open to it, right? Like focus on finding the deal, right. Number one, but also focus on, the biggest thing is really the net worth, right? The net worth is the big piece here. So as long as you focus on trying to find that guy, a lot of these guys that are in the group especially have experience. So that's an easier piece to find.
So that's ironic. So when you think about it, when you look at Brad's group, everybody coming in is usually pretty well off. So they have net worth and liquidity. But then the people who have multifamily experience, they're going to take a larger percentage of your equity. And so when you go out and you start trying to negotiate with these guys during your dating period, you might have the deal and you're going to take 20% of the deal. But now you've got to sort of divvy up the pie between multiple people. And so if you go to somebody and you're like, can you sign on this deal? And they have experience, net worth and liquidity, they're going to help you raise equity. They're taking a bigger chunk of that pie.
This is for you.
Yeah, you got a small piece of the pie. And so some people you have to be a little bit more strategic with it and say, look, all right, I'm going to take 10%. Now I've got 10% to divvy up between multifamily experience, potentially equity, and then net worth and liquidity. And so depending on what you need, it becomes, you become more and more valuable to that group. And if you have all the pieces, you get the full 20%, right? So that's why when you start thinking through these, the more options you have in terms of key principles, the better. Yeah. And then also, another piece that I see people get hung up on is, they want to be a sponsor on a deal, but they don't know how to convince somebody to sign with them, right? So let's say I win a deal and I'm trying to convince you to sign on the deal, and you're like, why am I going to? I don't even know you. So I like people to sort of build a relationship with people who have multifamily experience already. Gotcha. So whether that's investing as a limited partner or helping them on their deals, maybe doing some legwork on some of their deals. Something to build that communication and relationship so that you stand out, so that when you go and make an offer, it actually stands out, right? Because this sponsorship group is important for the loan, but then when you're making offers, it's also important that
you look strong.
Yeah, your sponsorship group is strong. And I mean, this comes to another point is when you submit your initial offer to a listing broker, it's usually, let's say there's 10 people, then they're going to go into a best and final, and you're going to fill out a questionnaire, and a lot of times they're going to say, all right, how are you doing your loan? and how are you doing your equity.
Yep.
And so really having not only a mortgage broker to say, all right, this guy can qualify for the loan. Sometimes I'll write like a letter of recommendation for people with their track record, and then also with their track record of raising equity, sort of putting that all together so that the listing broker gets comfortable. And so it's sort of
kind
a
of validating.
third party
Yeah.
Validation for that buyer.
Yeah.
And
That's
so
important.
that's helped a couple of people win deals.
Yeah, well,
And-
it's we both know it's
Yeah.
a very unfair business,
Yeah,
right?
it's-
So
yeah.
you're looking at who the GPs are on each one of these offers, and you're saying, I don't know this guy from Adam, and
Yeah.
right, like, and then so if someone like you comes in and you've got all this experience working with these brokers, and
Yes.
these lenders, and you say, yeah, this guy's going to close, right? Like I know his board, and they're square. He's going to have a heck of a lot better,
Yes.
Yeah, he's going to have a better chance to close that deal,
That's right.
or
Yeah.
win the deal.
Win the deal.
So very important stuff, very very helpful stuff. Do you want to add anything? I usually end with like what's a lesson learned,
Sure.
or something that you might be able to share that has happened recently or in the past, or maybe it's a common mistake, but something that maybe a gold nugget for the viewers to take home, or just kind of keep as far as hey, don't do that.
Okay. I'm trying to think. I mean, it really comes back to team. I
Yeah.
think a lot of people, one of the things that I recently saw, like Tim Ferriss put this out on, it was essentially like top 10 things that startups need to do in terms of success. And one of them was just like hire the best people and just get out of the way. And so I think a lot of people have come to you guys to really get the best in education and mentoring. So you've made that correct step. Now the next step is really to hire the best team for your debt. And I think there's so many different things that can come up in a transaction and sort of leverage our expertise. Like this is what we do.
Yeah.
This is how our number one thing is sort of execution certainty. So if we give you a term sheet, that's what we're going to deliver on, versus just giving you sort of the pie in the sky. I think the lesson learned for a lot of people in the last probably last year is that a lot of people have been promised all these things on term sheets that are one page and promise you everything, and then they get further down the road, and then when they go to actually close the deal, that was just all sort of smoke and mirrors,
Exactly. They're
and
getting
not
sold.
the actual
Yeah.
actual deal.
Yeah, no, I
And,
couldn't agree more. Honestly, I'm a huge advocate of that. Actually, is just you let the experts do what they're experts at.
Yeah.
Right. Like I don't dabble and try to learn things as I go. Especially when I have hard earnest money down.
Yeah.
Especially when I have investors' money in my bank account or whatever the case may be. Let the experts do what they do. It's going to be your best chance of success for sure. That's very good advice.
Yeah, and I mean, I think the thing that's a little bit different for us is, yes, we do financing, but I think some of the things we mentioned in terms of the podcast, in terms of like our conference, in terms of our speaker series, all these different things, we try to help you as a general partner grow and introduce you to more and more people. And so, very rarely does a banker do that.
Yeah.
I think a lot
I
of
agree.
times
I agree.
they think, we're here to do the loan, but sort of all throughout the process, we're helping you in different ways.
Yeah, you guys are definitely a very, very unique company, and as far as the podcast and everything you do, that brings me to my last point. Really, is so talk about how they can find the podcast and how they can reach out to you if they want to, or get any of your white papers or whatnot.
Yeah, I mean the easiest way, Old Capital Podcast is the easiest way on the podcast. You can go on iTunes or Stitcher or any of and to subscribe to that, and then. Our website is oldcapitallending.com. You can put my email sort of in the show notes.
Okay.
But it's just jeng@oldcapitallending.com. That's probably the best way. Just reach out to me via email, and we'll set up like a 10, 15-minute call and just sort of go through sort of your current situation.
Okay.
And, I like to provide people sort of next steps. So we'll typically fill out a personal financial statement, which all your students do. And then we'll sort of walk through, all right, which path are you going down in terms of independent, individual, or sort of syndicator? Then we sort of lay out sort of
Options,
steps from there on, how to position yourself, whether it's forming your sponsorship group or just sort of whether you need to meet, who do you need to meet in those markets
Yeah.
a lot of times.
Yeah.
And so providing introductions.
You help with the strategy from all aspects of the deal, right?
Yeah, and I mean, I like to tell people sort of pros and cons of each one, and a lot of times people are looking one way and then another opportunity comes up their way. So just being prepared for your opportunities is key.
Yeah. Good advice, man. I really appreciate your time today.
All right.
Thanks so much.
Thanks, Carl.
Hey, guys, thank you so much for tuning in and watching this episode here in the Sumrok Studios with the top service provider, James Ng from Old Capital. I will definitely post a link below the video to share these white paper reports. I'll probably just send them to your website where they can download this stuff to make it
that
easy.
works. Yep.
Very, very helpful information here, you guys. I mean, it's the white paper report that they have. What's the main one that you guys have? That
We have a multifamily finance like 101.
Okay, yeah. So it's a beginner's kind of white paper. It gives you everything you need to know, and then how to finance. This one I found really, really helpful, just kind of giving you the different options and whatnot. So I'll make sure you guys have access to those. Again, these are one of our, James in Old Capital is one of our top service providers here at Brad Sumrok. And thanks for tuning in, and we'll see you next time.